Good afternoon, everyone, and welcome to the monthly Roundup webinar for April. This is our, air quotes, virtual cup of coffee, where we get together, we talk about what's been happening around the Denver real estate market for the last month, talk about some news, how the market is doing, and also do a couple deal analysis. So while we do this, please ask questions. We love them. Any question, anything regarding real estate investing, pop it in there at any time. We do monitor those and we do answer them fairly quick. Now, as you guys know, we do this webinar live once a month. I know it's really hard to always make it live or listen to the YouTube recording, but we always take the audio and put it on our podcast channel. That way, if you can't make it live, hopefully you can stay with us month to month to month and stay plugged into what's going on with the market. So I have Charles Roberts with me here today, who, as you guys know, is the president of Your Castle Real Estate and also an active real estate agent and investor. And so welcome to the show, Charles.
Thanks, Chris.
So Charles, we are going to start off a new segment. We're doing a little bit more organization here on our monthly Roundup webinars. And we're actually going to start off by doing a quick market recap for what's going on. So Charles, what are we looking at here?
So this is some great data from RE Colorado, and I use this a lot when I'm basically talking about the market and trying to understand it. It comes out once a month, so let me give you a high level of what's going on. What this is saying is it's looking at March of 18 over March of 17. So going back 1 year, the big numbers are the change in listings dropped dramatically again, change in
say those numbers, Charles, as you
certainly, yeah. Change in new listings is down 7.3% year over year. Change in sold listings is down 6.1%. So we're literally have fewer properties on the market than we had a year ago and fewer solds. And what we're seeing is we still have way more buyers than sellers. So the change in median sold price went up 8.8%. So those were the big numbers going down this way.
So let me jump in here. So when you say 7.3% less, how many properties is that? Like, is it hundreds or thousands? What's the... Right.
So what we have here now is the active listings. For example, in 2018 was 4,599. Snapshot, I think like March 1st or March 30th, whatever, of 2018. And that's 6.8% fewer than last year. So to understand what these numbers mean, it means that for years now, our inventory has been dropping. We have fewer sellers. Why? Mostly because sellers think, well, they can't find another place because it's such a tight inventory, so they're just staying and fixing up their kitchens. That's kind of what's happening. So we're getting a continuation of the supply and demand curve, where the supply curve, for all you economics majors like I was, is moving down, moving along the demand curve, and prices are going up. That's exactly what's happening, is we have a very restricted supply. People just aren't listing their properties. And if you heard this podcast a year ago, we probably would have said, okay, well, we got to be near all-time lows, and here we are down another 7%. And this is exactly why prices continue to go up. So active listings are down almost 7% year over year. New listings is down also about 7%. Fewer people putting their properties on the market. And the result is the average sold price in the last 12 months went up another 10.7%. So I can actually see some of the folks on this podcast, and I know some of you guys are investors, newer investors, and some actually more well, let's say you've been doing it for a while. It just basically add up all of the amount that your properties are worth and multiply it by about 0.1. That's about what you made in the last 12 months. And that's why there continues to be a lot of interest in this market, because prices are going up. Average price, another 10.7% increase, simply because there's no supply. That's what's happening in our market.
So Charles, got a question here from Doug. He's saying, are buyers trending towards buying new builds then?
Nope. Problem, Doug, and I don't know if we've ever talked about this, but not really. At least I don't see it. I've looked at that, and I've looked the last couple of years. The problem with new builds is they're so expensive. They're just very expensive. So like the entire continuum of rental properties, the more expensive it is to purchase the property, the lower your monthly cash flow is going to be, because the prices will go up more than the rents will go up. So no, I haven't seen that. It's still, and we're not doing that. I actually have a couple of colleagues who for years now have been truly speculating, have been putting money down on new builds, putting 5,000, 10,000, then up to 25 to 50,000 at some point during the project, and then selling them as soon as they're done. And they've been killing it. That's speculation. Nothing wrong with that. Is they understand the risks they're taking, but I can tell you, I don't know any investors that are buying new builds for rentals. Still not. And I don't really see that changing because the prices of the new builds will continue to pace the price of the existing properties, other things being equal, and they'll never be cash flow properties. So for a very particular buyer that wants a new build, wants a very specific property as an investment, that'll work, but I almost never see it.
And the comments, yeah, and your house with the new build practically touches your neighbor's house.
Right, but I mean, Chris, where did you just buy a house?
Highlands Ranch.
So you can pass the salt out from your, breakfast table and hand it to your neighbor, right? I mean, there's nothing wrong with that. Yeah. That's, you just bought a house here, you bought a beautiful house, probably not a large lot of land. So you're right, Doug, that's the case, but yeah, that's okay. I mean, people do that. The problem is you got to spend $400,000, $500,000 to maybe be getting, $2,200 or $2,600 in rent. I would love to see those numbers. If you have seen something that makes sense, Doug, truly reach out. We love these ideas, but no, I haven't seen many long-term investors buying new builds.
Anything else on this slide?
I think we're good.
So a new little segment we'll be doing also on this monthly roundup is what we're going to call the indicator. It's just, we see a lot of interesting data points or facts or numbers. So we're going to grab one, dive into it for a couple minutes. And what you're looking at is something Charles sent over to me a couple days ago. It's titled Still Broken, and it has a graph that is trending down. So what are you looking at, Charles?
Okay, so this is national data. And I want to start with the national data to show you that what's happening in Denver is not really odd. We're not an outlier. So what we see here is these are the housing starts per 100 households. And it's a 3-month moving average. So what this means, for example, is right here you had 2 housing starts in the 70s. I'm just kind of picking a time period right here per 100. Okay, so what you see is it goes up and down over time. So let's get more in our recent history. In the 2000s, we had a buildup in the market, and this is exactly what we saw in Denver. And we had quite a bit of building until the crash, and this is a very, very dramatic crash. Basically, housing starts just stopped. Construction stopped, and we saw the exact same thing in Denver. And then at the bottom of the market, right about here, we had a record low housing starts in the country and in Denver. And what you see is they've gone back up. So just, I think it was either yesterday or it might have been actually this morning, I heard Ben Marcus on Colorado Public Radio talking about new construction. And it's true, new construction absolutely has been going up the last 7 years, last 8 years. But what you have to understand is the bigger context. All of these, it's not suddenly like everybody left America and people stopped having babies. No. And especially in Denver, which is a growing metropolis, people moved here, but there was no construction. So yes, while there are more housing starts the last few years, we've got this big gap to fill. And what happens for the period of time that that gap isn't filled? Well, guess what? You have more buyers and not enough inventory, and that's why prices have been going up. I'm not speculating for the future. I'm describing the past. I'm describing the last 6, 7, 8 years in Denver and the last couple of years in the rest of the country. It's as simple as this. We have a population growth, especially here in Denver, and we have not kept up with the housing supply. That is the definition of our market.
So what happens? It just stays like this until more inventory?
Over time. Yeah, I mean, over time, right. I mean, so maybe everybody leaves Denver. That's, door letter A, kind of unlikely. Maybe this continues, this line of housing start continues and goes up, and sooner or later, the demand is satiated. Most likely that will happen. But the devil's in the details. Just to say, wow, we had a lot of housing starts in the last quarter, therefore the market's over and things are going to go down, that just misses the big picture. That's the whole point of showing you, going back to the 1960s, the big picture is that we lack housing for Americans across the country, and Denver Metro very particularly. We simply don't have enough housing because for this period of time, very little housing was built. And over time, my best guess is it will begin to normalize. But I don't know when, but I believe it's going to be several years away. I have no reason to think it's going to happen overnight, and the numbers just don't indicate that it's going to happen overnight. And this graph looks just like the one in Denver. More properties being built the last couple of years, but they have to fill this huge gap during the downturn when very, very little was built and our population still increased.
All right, so let's move on to our first deal analysis. Now, yeah, it was on last month's Roundup webinar. We talked briefly about someone in a 1031 moving some money over here and buying some properties. And this Dayton Street is a duplex, and that's one of the places got. So Charles, you were in the trenches on this, describe the property, pull up the numbers.
Sure.
So start the spreadsheet.
Yeah, let's do that. Actually, go to the MLS if you could. So I had a guy who sold a commercial property in San Francisco, had some money to move. So we helped him move some money. And here's what I can tell you is that I don't believe I've been in a purchase of a multi-unit, meaning a duplex or larger, in about 4 years. If you've been listening to our podcasts and webinars, you've heard us talk that mostly what people have been buying the last couple of years have been attached condos and townhomes, simply because the cap rates were better. But we had to move this money, and we were kind of running short on time. So we were looking at potential condos, townhomes, potential single families, but he wanted to move a little bit more in one big chunk. So we looked in Colorado Springs, and we looked in Denver Metro, the Aurora area, and we ended up settling on 436 Dayton Street. So this right here, just your very, very normal, almost stereotypical Aurora brick duplex. They were asking $449,900. We ended up settling at $445,000. And the story of the seller is really interesting. We ended up meeting him at the closing, but I knew the listing agent. He had given me a little bit of insight. This is a guy who's just a professional investor. I mean, he was just good. He's bought and held stuff, and he fixes and flips stuff. And the reason he put this on the market a couple of months ago was simply because he happened to notice that a whole bunch of the duplexes and fourplexes on Dayton were selling at a price he couldn't believe. And he just called his guy, Mark, and said, hey, Mark, well, let's see if I can get $450 for it. If I can get $450, something like that, I'll sell it. I mean, that's the story, is he figured, I'll just move a little money and do something else with it for this one property. And that's exactly what happened. So if you look through here, you see it's 1,775 square feet. They're 3-bedroom. They're relatively small, but perfectly comfortable. 3-bed, 1-bath, 888 square feet per side. And the rents are interesting because one of the rents was $1,100 and one is $1,500, and they're both very low. The $1,100, I think he bought it 3 or 4 years ago, and I don't think he ever raised it, which gives you a good idea of what market rent was. Let's call it 4 years ago when he bought it was $1,100. And
the units are identical.
Yeah, they're identical. 3-bedroom, 1-bath, 888 square feet on each side. We believed, we put in our calculations that I'll show you next, that the market rent is $1,650, and I actually think that's quite conservative. I'm getting, my 3-bedroom, 1-bath in Denver is getting $1,762. My 3-bedroom, 2-bath condos in Aurora South are getting $1,775. So $1,650 felt quite conservative. And again, nothing really fancy about this. Normal owner pays trash, water, separate meters for the tenants. So we looked at this, we had to do some negotiation. Of course, they had multiple offers. I believe our offer was cash. Yep, our offer was cash, so that sweetened it a little bit. And we ended up getting it for $445,000.
Okay, let's jump over the spreadsheet.
So let's look at the numbers now. You guys probably have seen this before. This is a spreadsheet we use. Joe Massey put it together. We love this spreadsheet. And this is exactly what we do. Again, if you're newer to this, just understand it doesn't get that much more complicated. We just put some numbers into a spreadsheet. And then, of course, we have to have the background and the context to understand what those numbers mean. So let me explain. The address, number of units was actually 2. So sorry, just change that to 2. He put, in this case, he paid cash. The spreadsheet was developed by a lender. So we'll assume you put 25% down. But for the numbers we care about, which is going to be the cap rate, don't worry about it. It's going to be the same. Purchase price was $445,000. And then acquisition costs, some acquisition costs, inspections, things like that. This would actually have been less because we didn't have an appraisal. But again, don't lose the forest for the trees. The big number is the 445, and we really had no initial repair costs. The place was, solid. Roof was good. A couple of little weird things about it. We came back with 4 or 5 things on the inspection objection, and the seller said no. It was great. I called Mark. Mark calls me like, "Okay, Charles, here's the deal. You're not getting anything. Do you want it or not?" I'm like, "I get it. I'm not surprised. I'm not shocked." Like, that is the market that we came in at 445, couple thousand below asking, but probably double what he paid for it 4 years ago. And we asked for what I would consider reasonable health and safety items. And I did let my buyer know I had no reason to think he'd give us any of this. But, if he did, great. If he didn't, no problem. And they came back and very respectfully said, "Yeah, we got a couple people in the back. If you want it, great. If not, don't worry about it. We'll cancel the contract, give you your earnest money back."
Can you give us an example of like one of the things, just so context?
Yeah.
You say health and safety, like what does that mean?
There was some older electrical panels, and they weren't Federal Pacific. They were, oh God, it starts with a Z, Zilst or something. And I'd actually never heard of them. And they looked older. They were, I'm sure they were original. And we did a little research, and they kind of said, yeah, they have some problems. Like Federal Pacifics are the ones that everybody knows about that are really bad. So I said to my guy, hey, let's give it a shot. They can't cancel the contract. Like, I don't think they'll do it, but that was something we asked for. And they said no. And then there was, I think, what was it? In the crawl space, there wasn't like lining, moisture lining. So we asked for that. They said no. Everything was no. Respectful, like really good. Everybody behaved themselves. Like nobody gets upset. It's just business. Mark gives me a call and says, "Hey, Charles, he's not going to do anything. Just let us know what you want to do." And I said, "Okay." And then we ended up getting it. So no problem. But that is the market these days. I wasn't surprised. So we put in numbers like vacancy factor. I throw in 5%. Right now it's about 3% in Denver Metro. It'll go up, it'll go down, but standard 5%. Annual rent increase, 4% is the 45-year average. That's what rents have gone up over time per year. And then annual appreciation rate, average is about 6%. Of course, it's been more like 10, 11% the last few years. We like to throw in a 5%. That's a little bit conservative of the last 40 years. My guess is it probably will go up about 5% a year over the next 20 years. And then we get to these numbers, the annual operating, not complicated. You type in the taxes, insurance.
So read those numbers off.
Sorry?
Can't see it.
Yep. Real estate taxes, $1,890. Property insurance, $1,400. He's going to manage it himself. Repairs and maintenance, we put in $1,000, figuring, just put money aside for paint, for damage, a broken window here or there, once in a while, a new hot water heater or something. So these are called reserves. This is like a reserve account. It makes sense. You're going to have expenses. So account for them. And then water and sewer, I've owned duplexes for a long time. This is a reasonably conservative number for what we expect. Water and sewer would be about $1,000 per year. And then that's about it. Those are the expenses. So now let's get to the cash flow and the reason we bought this property. And I'll tell you, this property was actually quite a bit better, even at that price. This property was pretty solid. It came out at a 7.3 cap rate, and that would be the net operating income, meaning all the money you get in versus all your expenses, assuming you own it outright, not accounting for the loan. The cap rate was a 7.3, and that's pretty good. In this market, even at $445,000, with $1,650 as the estimated rent for both sides, for each side, I should say, a 7.3 cap is good. And once he gets the new rents, I'm thinking it might be higher. Like, I'd love to hear this was a 6.6 or 6.7. I'm sorry, 7.6 or 7.7, maybe even a 7.8 if we can get to the 17.25 or so. But even at $1,650, which we think is fairly conservative, this is a 7.3 cap. Not bad stuff.
Well, you don't see too many multis in the 7 range.
No, we really have been looking, for a long time. And the fun thing about this business is, the moment you think you know it all, you get humbled immediately. And this to me was not exactly a humbling moment, but honestly, decent duplex. okay area at a 7.3 cap, yeah, I would do more of those if we could find more of those. So maybe one thing you're getting from this, those of you guys who are listening, is, well, maybe we actually should be looking for more of these, because we're really not getting much better for the 2-bedroom or 3-bedroom condos and townhomes we've been buying lately.
And where'd you guys find this deal?
On the MLS. Yep, this was straight up MLS. Multiple offers, write a good offer, be good to the other side, be professional, answer your phone. I'm telling you, I just cannot stress enough just to be professional. For you agents listening, yes, I'm talking to my compatriots, just be professional. And for you buyers or sellers, like, getting angry or getting emotional just doesn't help. I think it hurts. And I think it also hurts because people don't want to work with people who are unprofessional. And I was really, when we had the closing, it was just a great closing. Everybody was good and professional, and we were glad for them, and they were glad for us. And it kind of makes this business fun. And the buyer got the deal he wanted.
So if you guys have any questions on this deal, submit them. Doug did ask a question. Oh, this is going to be a fun one.
Oh.
So what are your thoughts on rent control? I've heard the news that Denver is considering it since rent has outpaced wages and become less than affordable for some.
Yeah, we've been looking at rent control here for for years, actually. My relatively short answer, I mean, you're actually asking, what do I think? I don't even know exactly, do I think it's going to happen? No, I don't think it's going to happen in Denver. So honestly, Doug, I don't spend a lot of time thinking about it. Do I think it'll solve problems? Honestly, no. I think it'll actually cause more problems in the long term. So if I was a Democratic member of the legislature, I would be probably for rent control because it sounds great. It sounds like you're helping people. The problem is, over and over again, what you see when you bastardize the market is that you actually end up hurting the people you want to help. And what this means is, Doug, you're going to buy fewer properties and make them rentals. There's going to be less development, less building, less conversion of rentals, and that's going to reduce the supply, and it's going to literally hurt the very people it was intended to help. And listen, I'm not a Republican. I'm not a Democrat. I'm right down the middle on these sorts of things. But I actually believe that. I really do believe, and case studies show around the country, New York being where you start, that when you bring government in to produce answers, oftentimes those answers have unintended consequences. And I do believe the unintended consequence will be to reduce the supply. So you want to hear something funny, Doug? I'm all for it. Why? Because I'll make more money as an investor. And I'm only kind of being tongue in cheek here. Like, I'm trying to do the right thing, say the right thing, and be a good person. But the fact is, you know who's going to win? It's going to be guys like me who have a bunch of rental properties. And you know who's going to lose, in my opinion? The very people who think they're going to win, the tenants. The tenants will probably lose, and the investors will probably win. So that's what I think. What I think is, it's not going to happen in this part of the world, maybe in Boulder, but I don't think it's going to happen on most of the Front Range. And if it does, I'm just not worried about it. I've got 5,000 other things that I'm more worried about, or things that are worth more of my time.
So something interesting. I mean, before I became an agent and lived in Denver, I dipped my toes very briefly as a commercial multifamily agent. This was for like 2 months in Los Angeles. And the little territory that I was assigned is a place called Torrance, California. Everyone knows it. It's kind of it's the beach side of LA. And Torrance, it was like two-thirds of Torrance, and then about one-third of it was LA unincorporated county, where they allowed rent control. Torrance City did not allow rent control, and LA County allowed it. And there was, one is a major boulevard, kind of that split the two sections, and the difference between walking across the street was astounding. And I was actually like having to go out there and like take photos of the properties and drive the properties to build a database. And so I did all the properties on one side. I think it happened to be on the non-rent control side first, just because the way everything was laid out. This is like a weeks long process. I was doing this, and I did the rent control side, and I mean, it was like slumlordy. It was, things were not fixed. Everything was, not everything, but a lot of things were falling apart. Just everything was worse over there. And it was a very interesting experience for me, because what Charles was saying, where it's designed to help people, I think it ends up hurting them, because on a whole, all the apartment buildings over there, and these were everything from like fourplexes to 15 buildings, they were dumps. Anything else rent control was an absolute dump. And it was way worse than anything else that was not. Like, and it's seeing we know in Denver, like, all the Section 8 stuff, like all the places for Section 8 are way nicer than anything I've seen in rent control. And just very interesting dynamics. I agree with what you're saying, Charles. Like, it was an eye-opening experience for me.
I mean, some of my Section 8 units are nicer than where I live, for God's sake. So I don't know, Doug, that's my feeling. You do a Google search, for rent control case studies. It's not all, like we said. Maybe it helps some people and helps some renters. Of course, it's all down the middle. So if you're paid to promote rent control, you say one thing. If you're paid to, desecrate rent control, you're, the other thing. But most of it is in the middle. But I think by and large, believe it or not, it'll be the investors that win if we have rent control. And that shouldn't be our government's policy.
All right, so we are going to move on to deal number 2. And this is actually not a buy side. This is probably the first time in the history of us doing these Roundup webinars for, I don't know, like 9 months now, that we'll actually be talking about a listing. And I actually asked Charles to do this because it's very interesting, because it's actually a fourplex he listed for an investor who I think bought 4 or 5 years ago. I'll let you run, but it's just very interesting to hear the numbers and just how everything has progressed. So,
yep. Okay, so this was, I believe, the last multi-unit we bought. I think it was like June or July of 14. So I think we're on 4 years now, okay, because of where we are right now. So what this is a fourplex. And for those who can see it, if you're not doing a podcast, you see this right here is a little unit, which is a duplex. And there's the second duplex here on a big piece of property on 241 South Hazel Court. So my guy bought this about 4 years ago. He paid $365 for it, $365,000. And let me just show you, this is the listing that we just listed it for, but let me tell you a little bit about the property. So what you see is there are 4 2-bedrooms, and they're tiny. They're 600 square feet. I mean, this is 2,400 square feet total. And, if you're an investor and you're saying, oh God, should I buy this property? And it's so much, is this and that. When you do this for a while, you sort of chuckle, because I swear to God, it's exactly what Jake was saying very, very correctly 4 years ago. Oh my God, it's $365. It needs a lot of work. Do I buy this? And he ended up deciding to buy it. He thought he was going to put about 70 or 80,000 into it. They were, in pretty tough shape. He ended up putting over 110,000. He had some, I think it was lead-based paint. I don't think it was asbestos, but I think it was lead, and the city got involved. And let me tell you, it was he put a lot more work and more money into it. But let's say he put 110,000 into it. He's into it for 475 already. But over the last 4 years, the market, as you know, has just skyrocketed. And here's where we got now. So he says to me a couple of months ago, hey, let's go.
Sorry, real fast.
Yeah.
Remember what the rents were back then? Just to have like a snapshot of like price and rents versus now?
I'd have to look. I'm going to guess they were 700. Yeah, in the range of 700.
Okay.
Yep. So they were okay cash flow, but he was thinking long-term buy and hold, actually add some value to it, which he did. So he held it for 4 years and now has decided to sell it. So this is what's interesting. And for those who worked with us, this should sound familiar. He gets to me over the winter and said, okay, Charles, we're going to sell the property. What's it worth? And I said, well, I'll look for comps. But of course, like most of these are pretty unique. So what we ended up doing is what I think is exactly the right process. Whether you want to buy or sell, you need to go out, spend time in the market physically, and figure out what's out there. So what we did is we looked at a whole bunch of duplexes, triplexes, and fourplexes in Denver Southwest.
Like you actually walk the property?
Absolutely, yeah. For the ones that were active, we walked them. And for the ones that were sold or under contract, we would just drive by them just to see what the neighborhoods were like. And we used the spreadsheet. We used Joe Massey's spreadsheet. And we did the best we could to estimate all the costs and the rents. And what I was coming up with is roughly what is the cap rate of sort of similar types of properties, whether they're duplexes or fiveplexes, sort of similar. What is the going cap rate? In other words, what are buyers paying for that income stream? And what I came down to was low 6s cap. That's pretty much what I expected, actually, which is why we haven't been buying too many in these neighborhoods, because we're getting low 6s cap typically. So what we ended up doing is we took the net operating income, divided it by 0.063, and we came out to a purchase price of $779,000. And that is the process. This is not higher level mathematics. This is just some, shoe leather, looking at properties, trying to figure out what investors are paying for somewhat similar properties, and then doing some quick math, and that's what we came out with 779.
So you used a 6.3 cap rate.
Yes.
Okay.
So, divided by 0.063, but it's a 6.3 cap rate is what we assumed a typical investor would pay for this property in this condition in this neighborhood.
And that was just the average of everything you guys saw. So you saw 10 properties.
Yeah, kind of. So I'm sitting here kind of squinting because no, it's not like we added 10 and then did the math, because that's very misleading. That makes you think you know what you're doing, but you don't. Believe it or not, we kind of said, well, is it a little more like the 6.1 or like the 6.5? Is it kind of like the 5.8 or the 6.7? And then we just basically agreed 6.3 was about right. So we could have done that math, but I actually don't think we would have come up with a better answer, because it's half art. It's half like, what did you think of this one? Yeah, this one's maybe a little bit closer. And that's how we came up with what we figured was close. Is it a 6.1 or is it a 6.5, a 6.2? We came out with 6.3.
Okay.
And that's why we priced it at 779.
And this is under contract, or is it closed yet?
So we put it on the market, and 24 hours later, I guess I'm kind of not supposed to say what we're under contract for, but consider it about a full price offer. We went under contract, I think maybe 26 hours later, at just about asking price. So at the moment, we did the appraisal yesterday. My seller is actually out of town, so I emailed him, let him know, Dan, the appraiser showed up, and of course, this is a big deal. Like, this is a lot of money here. So I met him, and I actually sat with him, and I said, hey, Dan, can I just kind of show you some data on the property? I was very polite, and the appraiser was very polite. And you know what I did? I actually gave him 5 or 6 little packages showing a listing, and then Joe's spreadsheet on paper saying, hey, this one came at a 6.1 cap, this was a 6.3, this was a 6.4, and then I showed him the spreadsheet we made for this at a 6.3 cap. So what I'm telling you is exactly what we did, which is exactly how I'm trying to convince, influence, inform, whatever you want to call it, the appraiser. Like, it really is worth 779.
So what are because I know there's different ways appraisers could calculate the value, and I know, ego is getting involved in here as well. Like,
yeah, I'll let you know in a week.
Yeah. Okay. I'm just really curious. Like, I guess
we'll find out. Yeah, he was great. He was, obviously understood what I'm saying. We'll find out in a week, and I can only hope we get it, because truly, like, the market has said it's worth this because we got a full price offer, and we didn't just pull it out of a hat. I actually have good data, so I'm doing everything I can to support the value. And the appraiser was great, respectful, seemed to know what he was saying and doing, and everything was good. So I'm crossing my fingers, because I really do believe it should come out at the price that we have it under contract. But I'll know in a week. Yep.
All right. If you guys got any questions on this property or multi-units in general, I know a lot of times we get people asking, oh, I want to buy a multi-unit, and then we look at the numbers and compare them to single family, and they're like, oh, well, maybe I'll buy single family. So if anyone out there has questions, whether you're an investor or an agent, great time to ask it, because obviously Charles is done a lot of both, but very active right now in some multifamily. So fresh stuff in his mind right now. So reach out with questions, or afterwards reach out to us. We got questions as well if you're checking out the podcast recording.
So let me throw one other thing out at you. I had a guy named Eric who in 2000, I think 10 or 11, he started buying multi-units from me. And of course, has made billions of dollars. Like, he just bought when no one else did, super guy, and he has several. So he reached out to me Saturday, a few days ago, and said, hey, Charles, I'm thinking about selling one of my properties. It's in Lakewood. It's a fourplex in a very fourplex area. And he said, I want to buy a 16 unit where he lives now in Tampa. And let's talk about selling this fourplex. So what I did is I said, well, yeah, let's talk about it, because I have all the data. And I sent him over this data and said, look, get me the rents, get me everything current, and I'm going to divide it by about 0.063 to get you what I think the purchase price should be. So just so you know, I'm actively doing one right now. He's almost certainly going to list it. I'm going to take a look at it with his property manager, because he's from out of town. And, just let me know if you're looking for a fourplex, because I've got one that's going to be coming down the pike. You're not going to get the world's greatest deal, but maybe you can take a look at it before other people do. And, this is how we get deals done.
Well, what are the very rough numbers? Rough
yeah.
Layout? It's a 2-unit?
It's a 4. Yeah, they're 3. They're They're up-down duplexes, built as duplexes. They're brick. He's getting, I think, $1,000 for rent for each of the units, which I thought was kind of low because they're relatively spacious 2 bedrooms, and I'm getting almost $1,400 for my 2 bedroom in Lakewood in a condo complex, and it's nothing fancy. But he said he's getting 1,000, so I haven't done the numbers yet. I'm guessing it's going to be in the sixes, something like that, when we get to it. But first step is he's going to have his property manager, handyman guy named Jim, who was the same guy that I met years ago, show me the units, and then we'll start to figure it out. So in next month's podcast, I can talk more about it. But as long as we're talking about this stuff, I got one coming down that he wants to sell.
So we got a curiosity question. It seems like multi-units are difficult to make a cap rate over 7 on. Have you seen or considered yourself buying a vacant lot and then building a multi-unit on there?
Hey, Doug, give me a vacant lot that I can make the numbers work, and I'll do it with you. So the answer is not really, because it's very expensive to build, very expensive to go through the process. And why are you not seeing too many of these? I'll tell you why. Because they're too expensive. You see them in the Highlands, right? You see them in Potter Highlands.
But they're selling those.
Right. Because they're very, very difficult and very expensive to build. So the problem is the economics are such that it's hard to actually do new build rentals. The numbers just don't make sense. Like, there's a lot of people out there building stuff who are way better than people like me trying to figure this out. And what they're saying is, I got to spend $700,000 for a plot of land, and I need to build and sell them for $1 million, and sell, a patio homes each side for $1 million. Those numbers potentially work, but the risk is so high and the numbers are so tight for more rental type of numbers. This is exactly why you're seeing very, very little built in the lower to middle rental market. Numbers don't make sense. I wish.
All right, so we've got, as we come to a close here, getting last minute questions, guys and gals out there, type them in there. But I do want to draw your attention to some upcoming events. So Charles is teaching his advanced real estate class on Wednesday, May 9th at 10 a.m. and also Wednesday, June 6th at 6 p.m. So these are on the calendar. As I go through the dates and the times and stuff, just check the calendar, which is in the link on the show notes or on the website, or go to your Castle training calendar. But if you guys have not been to Charles's advanced real estate investing class, it is one you definitely want to make. It is my favorite real estate class I've probably ever been to. And it's actually something that he could charge for because it's very, very good content, but it's all free. So come there, come ready to pay attention, ask questions. It's always a lot of fun group discussions. And if you're coming to the June one, let me know, because I'll be there myself as well, taking notes. And then a couple weeks ago, Charles had the privilege of being interviewed on the Bigger Pockets podcast. And if you guys don't know what Bigger Pockets is, it's probably the biggest online website, social media resource for real estate investing just nationwide. They're like I'll say an education company. And Charles interviewed about 3 weeks ago, and should be coming live on May 10th. So be on the lookout for that. We'll just type in Bigger Pockets to your podcast app and listen to it. And it's a fun hour-long-ish interview with Charles done by the Bigger Pocket guys. A couple other things coming up. We have a house hacking class, or a couple of house hacking classes coming up Monday, May 14th at 6 p.m. and Tuesday, June 12th at 6 p.m. So this is more for people that want to do owner-occupied, whether it's they want to buy a place and then rent out the other unit, or do Airbnb, or simply live there for a year, not have roommates, but then in a year or two move out and buy another place, but use 3.5% down, or 5% down, or 10% down, percent down payments that investors simply can't get, but owner-occupieds can. We'll go through some case studies on there, some numbers, and we'll be teaching those classes. And the last thing I'll cover is a fairly new lunch class that Greg Parham, our first line started, called the Investor Advantage. The next one's coming up Wednesday, May 16th at 12 p.m. at Dave & Buster's. And Greg, who is a real estate attorney, is actually talking about wholesaling, how to structure deals, and actually drafting contracts. And he's also trying to get a few wholesalers to come out to talk about the process and how to do things. So I know many people out there are interested in learning how to wholesale, whether it's they want to do it themselves or buy. So if you can make this, definitely do. This is the one class that you can actually show up to. You have to RSVP in advance, and I think it's $25 at the door.
Yeah, and just so you know, we actually do sell out. So with Dave and Buster's, they're very, very serious. I think we have like a 55-person limit, and we sell out every one. And like, I'm not joking. If you show up and say, just let me in, we can't. So definitely just do it ahead of time. All of our other classes, we'll just stack chairs. We'll figure it out. You'll sit on someone's lap if you have to. But this is one that they do not allow us to do that.
Yeah, you know, all that fire code stuff. Great. So that is it for this month's Roundup webinar. I think we hit all the questions. So Charles, thank you for your time and coming out, and everyone on this webinar and listening to the recording, thank you for your time. And you know, we'll be doing the same thing in about a month, do a May monthly roundup. Have a great day, everyone.